Alright, what's up, boys? It's Kylie S. I'm going to teach you guys how to trade inversion fair value gaps and how to identify them and basically what they mean. So in the last episode, I went over a fair value gap and what it was. Something like this, right? Now, this is a perfect example of a regular fair value gap. An inversion, let me show you an example. Inversion is just like a fair value gap. Think of, let me see here. A fair value gap is the inefficiency of the orders being filled. It's a some sort of inefficiency. It's a price inefficiency, right? Something like this. There might be resting orders here, right? But an inversion would be something like this. So this originally was a fair value gap, right? It is now an inversion. Why? Because we had an opposing candle closure. So this was a bearish fair value gap. We came down, traded down a little bit. We came back up and closed very strongly above it. You could. Some people might say you could close a little bit above it, and then it's an inversion. And if price comes back down in here, you'd go long instead of short like you normally would. So basically, you invert it. So it was a bearish FVG. Now it is a bullish inversion. Does that make sense? So it's a bullish inversion FVG. So it's gonna basically, if price comes back down and touches this, you might expect to see some sort of resistance. I fucking hate that word, but you might see some sort of reaction. Might. So look, it came up here, instantly respected it. Touched, came down, instantly respected it. Came back down, respect, came back down, respect, came back down, respect. It's not ever going to be perfect, but this is one of the confluences that you can use in your toolkit. Context matters so much with this shit, though, because you could say that this right here is an inversion, but I might not use that as like a high probability inversion. It just kind of trades above and below it. It's not really something I'm looking for. If the price is right here and none of this has existed yet, and price is right here, and this is where price is currently at, what I'm looking for isn't something like this. I'm looking for the liquidity above and below, maybe, as far as high time frame inversions go. So let's say we have this fair value gap right here. Price comes, taps into it, and then we respect it. That's one bullish confluence. We're failing to trade into it or below it at this rate, so there's a lot of resting orders here. That's high probability. The same applies for inversions. This right here would be like a low probability inversion, and this right here might be a high probability. It's high probability because you see massive swarms of price coming into it. Maybe not initially. Initially, it looks like nothing happened, but this is at some major liquidity. This right here doesn't seem like a valuable low until you start to see in the future that price is trading way above it. The higher price is, the more valuable that low liquidity is. That's what people are aiming for if they're going short. The same applies to bullish. This right here, we could even look at the now. This right here is a very, very valuable buy-side liquidity. It's a very valuable liquidity. People want it, right? If price comes up and someone's like long right here, their TP might be up here. Their take profit, right? So you have to look at how valuable is this confluence. This is valuable liquidity down here before we even touch this liquidity, because sometimes price comes just to it and it fails to take it. Like, you see how close this guy right here, it come up? Sometimes it gets like within a tick. It's like right here. It fails to take it, and then it tanks. Why? Because all you're looking at is liquidity levels. You're not actually looking at any other confluence. Price right here failed to take this low. But what did price do? Price came down and was showing signs of respect towards this. It consolidated for a little bit, and then it respected it. That's what you need to look at. That's what high probability liquidity is. That applies to every form of liquidity. So, for instance, highs and lows, buy-side liquidity and sell-side liquidity, I'm not necessarily just looking at this high and this low right here. Or let's even say the 1 minute. I'm not going to be like this right here and this right here. If this gets taken out, we're bearish. It might get taken out, and then we just start trading super high up. Like, that's just the way the fucking cookie crumbles sometimes. At the end of the day, just try to remember, the higher the time frame, in my humble opinion, the higher the time frame, the more important the confluence. You can see a bunch of inversion fair value gaps right here. Boom. 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 At the end of the day, that's cool and all. But this middle one I don't give a fuck about. Why? Because price does not seem to show any sign of respect or remorse. It just takes that shit. It doesn't fucking matter, and it trades above and below it. This right here, yeah, kind of. I could see something there. But I'd say like mid probability, because we saw price come down and respect this right here. Something that's probably more important is just the normal fair value gap that's right here, right? Because it's coming down and touching it and retracing upwards. But you can pair a fair value gap and an inversion as like double liquidity if you'd like to. But at the end of the day, you want to see what is price hunting, right? Price is coming down. Price was hunting these lows. That's why price is now trading back up. It might trade up a little bit here. It might trade up a lot to manipulate, but price came down and took this liquidity out. That is the fact. That is what happened. So I'm not saying... The reason why you want to pay attention to why liquidity matters so much and the time and place of liquidity is because you want to see, right, if price takes this, it's much more likely to reverse now because it took this. But it might take this liquidity. This liquidity is very, very valuable, but this liquidity is even more valuable. You never know. Let's just say price comes down and does something like this, takes this liquidity right here, right? Even if it were to continue down, it usually will come up a little bit, retrace, and then tank again. Because it took that major liquidity, that's where most people's take profits were at. So a lot of them are just done trading altogether when it comes to that point. So that's what you got to focus on. So basically context and how important liquidity is when applied with time and price. You want to see how price is reacting to it. That makes a higher probability. Price could come back up, tap back into this again, and reject off of it. It's more likely to do that than anything with that middle inversion that this one right here, because this one doesn't really do anything. Same with something like this. Like, let me find another one. Here's another inversion. This is the one we went over. Something like this, I'm not paying as much attention to because price is just going to trade above and below it. I don't think price is seeking or gives a fuck about anything in this range because it's like middle of the range. Usually the edges of the range is what people are aiming for. So this liquidity right here failed to take this high. This is living proof that this is very that people really want this liquidity. People really want this liquidity. It failed to take it here. I'm sure a lot of people ended up getting stopped out because it traded back down. It failed to take it, and it violently takes it later. That is how highs are taken, and that's just generally how smart money moves. How I personally use inversions, I usually don't use them too much on the higher time frame. I usually use them on lower. So let's say I was looking for some sort of entry, like a major move. Okay, we'll just use this huge move right here as an example. No real inversion here. Maybe some smaller ones, but... So, because they don't always present themselves. I'm going to be honest with you guys. It might have on the 1 minute, actually. Don't always bet on that, though. Yeah, not really right here. Let me find a better one. I mean, this is another example right here. Like, this is just a great example. I'm just going to stick with this one. Price came down, and eventually, at some point, respected this and continued to trade higher. But that's high time frame. Low time frame, I usually don't always use inversions as a form of entry. But, like, let's say I did, this one right here would be a good one. Here we go. I found one. This right here was a fair value gap. It turned into an inversion. Price came back, tapped into here. Great long entry. That's a great fucking long entry. Then it trades higher. Take these highs. Take fib level of those highs, whatever it is. That's how I would use an inversion. So if you have any questions, just leave in the comments. Peace out.